Well, it is my great pleasure now to welcome Dr. Raghuram Rajan to our program today. Dr. Rajan needs little by way of introduction, but let me be brief. He is one of the world's most respected economists, currently the Katherine Dusak Miller Distinguished Service Professor of Finance at the University of Chicago Booth School of Business. He served as the 23rd Governor of the Reserve Bank of India, where he was widely credited for bringing down inflation, strengthening the banking system, and introducing key reforms that have had a lasting impact on India's economy. Dr. Rajan's distinguished career also includes serving as the Chief Economist and Director of Research at the IMF. Dr. Rajan, great to have you with us here on the program. It's an honor, sir. Prashant this side. Dr. Rajan, if I can start by asking you whether, the good news on tariffs, when I say good news, I mean, this handshake type of deal that we saw between the US and China. It's not even a deal, as someone said, not even a framework deal, but at least an agreement to start talking. Or the one with the UK. Have we seen the peak of the good news cycle as far as tariffs go? And will things get more contentious into the rest of 2025? What's your assessment, sir?
Well, I certainly think that what we need to have is more certainty on where the tariffs will land. Right now, we have, as you just said, an agreement to talk. But at the end of this talking, what happens? And talking takes a long time. So even while people are talking, are tariffs going to go back to the Liberation Day level on July 9th, 10th? For the rest of the world, is it going to go back to the Chinese levels on August 10th, 11th? I think the sense is certainly the level of tariffs that were announced in Liberation Day are probably untenable. And so they will have to be negotiated down. But where and when is the kind of uncertainty that harms business considerably also. So a lot of businesses waiting to see, are they going to keep the tariffs, at least while the talk is going on, at the 10% level for most of the world, or is it going to go back up? So some certainty on that would also be most welcome.
Dr. Rajan, when financial markets do well, it kind of papers over a lot of other stuff, some of the underlying issues, etc. And if you look at the big markets, they're all a few percentage points away from all-time highs. It's almost as if tariffs really will not hurt. I mean, they're pricing in little to no damage because of tariffs. What is your sense? Is it possible we actually, escape any consequences, or do you think it'll show up? Not now, but maybe a little later.
Well, there is something somewhat funny about financial markets that as far as policy goes, especially when policy is as unpredictable as in the current situation, it seems to almost be putting a probability of 1 based on the current environment persisting. So when the US raises tariffs on Europe, immediately markets react negatively. The moment there is a discussion of a pause, they react positively. So I don't think markets are really pricing outcomes effectively. They don't quite know, and they're putting a lot of weight on continuity right now.
Just one more question to finish that loop. Do you think the tariffs are being used by the Trump administration as threats to negotiate, or do you think they're very ideological about this? And, as someone said, President Trump, in all likelihood, will not... this is his last term, so it's not as if he's standing for re-election. So he wants to effect change and bring manufacturing jobs, American manufacturing jobs, back to the States. So I think, is this going to be a lasting theme throughout? Or do you think at some point, he's going to give in and then, watch the markets and the good stuff comes? What's your sense?
I think the tariffs are not going to go back to the old levels. I think there is some level which will stay, maybe the 10%, and certainly maybe more in certain areas like autos. And that's partly because of the ideological underpinnings of the current administration. They do believe the US has been unfairly treated by the rest of the world, but they also believe that tariffs can give the US a certain amount of sort of playing power. But I also think that right now with the tax bill, the big, beautiful bill under consideration, tariffs also play a role in being a source of revenues. and the US desperately needs a source of revenues to justify the level of tax cuts that are coming in the bill. So for all those reasons, plus the fact that I think it gives the US a lot of power because it's a big market for the rest of the world's goods, I think they're not going to go back to the old levels. The question is, are they going to be uniform across the board? Or are they going to be especially high for certain countries that are disfavored? And what is the longer-term certainty about the levels that are reached? Could it be that the administration turns on a dime and starts elevating them again for a country that it doesn't like or that has antagonized it? So I think a lot is up in the air, but almost surely we're not going back to the 3% level that the US was happy with before. It will be a higher level of tariffs.
Dr. Rajan, Surabhi here, and I'm glad you brought up the big, beautiful bill. I have a two-part question. So we're looking at two very big sort of events playing out right now. One is tariffs and whether the Trump administration can bring manufacturing back to the US or not. The second piece is the US deficit, and the bill is only going to be boosting that further. In the near to medium term, let's say if you take a 2 to 3 year view, what is the big economic reset that you forecast for the US economy? And the second part of that question is, and therefore, do you expect a flight of money, maybe not a big flight, a small flight of money, away from US assets, US treasuries, US equities?
First, I think the short run tariffs are disruptive, even to manufacturing. So we will see the consequences in the second half of this year. Will it bring back manufacturing jobs? Probably not a whole lot, because a lot of manufacturing, even in India, has been automated. Look at a cell phone assembly line in India, and you see machine after machine. These are not people screwing in stuff into the motherboard. That job disappeared a long time back. So I think when the jobs come back to the US, to the extent they come back, they have to take into account the high cost of labor in the US, which means it's going to be largely automated jobs. And jobs that will be created will be for technicians who man the machines, not for the guys doing the work directly. So big increase in manufacturing jobs, unlikely. But in the longer run, I think one of the concerns this has created in the rest of the world is, are we overly exposed to the United States? And you can see it in the talk amongst financial investors. 70% of global stock valuation was in the US. And now people are saying, well, maybe we're overly exposed. We need to rebalance our portfolios, both on the equity side, but also on the fixed income side. Are we holding too much in US treasuries? So when you talk reset, I think this portfolio rebalancing will play out for some time. It is one reason why the US dollar hasn't appreciated, even while there are global concerns about economic growth. It's because people are saying, do I really want to put more assets in the US at this point? And many portfolio managers are saying, maybe I need to rebalance, not necessarily because US growth is going to fall off a cliff, but because I just think I am overly exposed to my sense that the US exceptional performance will continue. I think more broadly, we're going to see supply chains move nearer home, wherever home is. That is a process that has been underway, but that'll get a special oomph under President Trump's policies.
Okay, so, sir, do you then see only a mild reset in market flows or in sort of investment portfolios? And what about the deficit? I mean, we're very used to it. Every year there's a debate on the deficit, and then, they sit on the fence. Eventually, the bill gets passed. Just a word on how you see that shaping up, and therefore what happens to yields?
I think it's not a mild reset. I think there is going to be a significant reset, especially as areas like Europe start considering whether they should be spending more, whether they need more financing. And Europe has been sending a lot of capital to the US. As Europe starts doing more infrastructure, as it does more defense spending, some of that financing will go towards financing European asset creation. And so I think there is going to be a global reset in portfolio holdings. And that will also be accompanied by price changes. You're already seeing a somewhat weaker dollar than anticipated at the beginning of the year, and that's something that could possibly continue. So this is on the cards. Sorry, what was your next question?
On the deficit and the direction of U.S. yields, sir.
Yeah, I mean, look, I think the big, beautiful bill is not yet fully done. I think the Senate will have a role to play. And some of the worries in recent days, which has sort of shown up in higher yields, not just for U.S. long-term assets, but also across the world, Japanese long-term bonds. I think people are very wary at this point about being locked in to longer-term investment in government securities, given the uncertainty about fiscal space, both in the U.S., but also in Japan as well as Europe. So what this means is that you can't take U.S. financing for granted. The U.S. debt to GDP is crossing 100% net in the next couple of years. And add to that a wider fiscal deficit embedded in a big, beautiful bill. And there are some sort of fiscal engineering also embedded in it, which says some of the spending or some of the tax cuts will come to an end at the end of the Trump administration. That is probably unlikely. So when you put it all together, this bill has to satisfy markets that it is not totally irresponsible. And I think the Senate, including the Senate Republicans, will have to play a role there.